What is up, guys? My name is Gustavo from Gustavo's Finances and welcome back to my channel. Today I want to talk to you guys about mistakes that I've personally made and learned from, as well as mistakes that I believe you guys should consider avoiding while investing. So one of my biggest issues has always been I don't allow myself to save or build up enough cash to hold on the sidelines for better buying opportunities. What I mean by this is I tend to just deposit money, and as soon as it's available, I invest it all into a certain company. Now the problem with this is, let's say there's a better buying opportunity that comes along. I don't have any money to invest and I can't execute on that buying opportunity. So instead what I consider doing is, for example, if I have $500 to invest, instead of investing $500 immediately, I should invest about half of that money so that I can have $250 sitting in cash. The purpose of this is, let's say a week later the stock goes down and there's a better buying opportunity for you. You have those $250 to be able to invest and purchase more shares at a lower price to lower your dollar cost average. So instead, you guys should avoid this issue, and you might consider to want to build and save up enough cash to hold in your portfolio for when better buying opportunities come along. Another mistake I've encountered was breaking the principle of buying low and selling high. And although this seems easy and is common sense, it's a lot more complex than people tend to believe it is. For example, I have bought many shares while stock was rising in value because I didn't want to miss out on that potential profit or those opportunities that I could have had if I hadn't invested in them. The problem with this is I was letting my emotions take control. I was being greedy, and I learned the hard way that greed is a good way to lose money in the stock market. So a perfect example of this would be a company I was invested in called Aphria. I was in Aphria at around $7 at one point, and this was a couple months ago, and Aphria had risen all the way up to around $17 and $18. So as I saw the stock rising, I only had a certain percentage of money inside this company. I only had a certain amount of shares. As I saw it rise, I wanted more shares because clearly I wanted more money. I wanted to get a better return. I saw it keep going up and I didn't want to miss out on these profits. So what I did, I kept buying more at a higher price than I entered in, and I kept rising my dollar cost average. And that's fine. I mean, it happens. It's nothing to worry about, but what I should have done was I was already at that low point. I wasn't being a savvy investor. I should have sold at that high point, at that $17 and $18. Now, like I said, it's very hard to predict the market. It's very hard to time things. And I didn't know it was gonna, come down after it hit $17, $18. Nobody knew that. And so what I should have done was I could have waited until it hit like 16, but instead I didn't sell. I wanted to stick with my principle of seeing this company long term, because that's why I initially invested in this company, because I wanted to be in it long term. Now, I did suffer the consequences from buying more. I had like a $13 dollar cost average, and Aphria went back down all the way to like $6, $7. Now, if I would have just applied that principle of just being patient and having half of my money in cash, I could have bought at a better buying opportunity. Instead, I just kept investing all the money I had deposited into the company, and when the stock did come down and there was a better buying opportunity for it, I had no more money to invest. I didn't have any money sitting on the sidelines that I could have invested to start lowering my dollar cost average. Now, within time, of course, I built enough money to buy more shares and lower it. But it's the principle of not knowing and not being experienced of buying low and selling high. It's a lot more difficult when you see a stock consistently go up. You just want to keep buying and keep buying and keep buying. You see, one of the things is buy when people are fearful and sell when people are greedy. I was being greedy, and the savvy investors knew that. Everyone was buying, and so while the savvy investors were selling, I'm out there getting left in the dust, if that makes sense. So something I consider you guys doing is, if there's ever a stock that you guys are invested in that consistently starts going up in value very quickly, invest half of that money and have half of it sitting on the sidelines. So let's say if the stock does come down, which I'm pretty sure it will because those savvy investors will be selling, then you can invest the rest of the money that you didn't invest back into it, and you would average out what you kind of spent, and you'd have not only more shares, but you'd have a better dollar cost average in the end. So another mistake you might want to consider avoiding is predicting the stock market. Now, predicting the stock market is honestly like impossible. Not even the savviest of savviest investors can predict the market. Warren Buffett can't predict the market. So I can't predict the market, and I don't believe you can predict the market. So instead of just worrying about the day-to-day fluctuations, if you're going to be investing into a company, it should be long term. You know what I mean? So the day-to-day fluctuations shouldn't even matter. Now let me give you an example of me trying to predict the stock market. So for example, I believe that a certain stock wouldn't go lower than this price. I'm like, no, the stock is worth this much, so it's not going to go lower than this. Of course it's not. Well, I was totally wrong, and so what I thought was I'd buy right now because it won't go lower, and a couple days later it's going to go up, and I'm going to get gains off of it. Well, I learned really quickly that the stock market fluctuates regardless of what I think, and so you can't really predict the stock market, so don't try to time it. Don't try to predict it. If you're going to invest in a company, invest in that company. Don't worry about, oh, this company isn't giving me the returns I wanted, when it was just like you've been invested in it for only like 2 or 3 weeks. Give it time. Anything good in life comes with time. And so, you know, just don't worry about those day-to-day fluctuations. Don't worry about if you invest in this company and it's negative a couple days later. Look at it, if you're going to be looking at the day-to-day fluctuations, then look at it for better buying opportunities. Not for you to worry and stress out that you're going negative. Not for you to worry and stress out that you think the company is about to fail. Because if you're doing your research and if you're investing in this company for a reason, then believe in that company. Like, they know what they're doing. Don't just sell because they haven't made the profits you wanted right away. Patience, self-discipline, patience. That's literally all that matters. And it'll make you so successful in the stock market if you are patient. Now, a huge mistake that I believe people should really consider avoiding is losing money in the stock market. Everyone doesn't want to lose money. No one wants to lose money in the stock market. So how do you lose money in the stock market? Well, there's a couple ways to lose money in the stock market, and here are the reasons. So a couple ways you can lose money in the stock market is, if you're going to invest in actual companies and individual stocks, you have to do your research over them. You have to do your research over them. Otherwise, you're not going to have anything to back up what happens if the stock goes down 10%. You're not going to know anything to back that up. Now, if you did your research and you saw it go down 10%, you're like, well, this stock is amazing. I researched it. I know it's a good company. You'd be like, well, that's a great buying opportunity, instead of selling it because you think it's just going to come down. Now, another way you can lose money is through emotions. A lot of people lose money because of the price fluctuations. They see that the stock isn't performing as well as they wanted to short term, and so they sell because it's not giving you the profits you wanted. Instead, think of it long term. Don't just sell a stock because it's not performing to the best of its ability right now. I promise you, within time, that stock is going to be so much better. It's going to be valued way more, and it's going to give you a lot more money if you can just hold it and not get influenced or emotional about these price fluctuations. The market is emotional when you're emotional. So when you're over there being greedy and you want to keep buying and buying and buying, of course the stock market's going to show green. And when all of you are being fearful and are scared of a stock, it's going to go down. It's going to be red. And so you got to understand that the market really just reflects people's emotions. Long term, it reflects the company's value, But short term, it just reflects emotions, and you guys really need to understand that. That way you don't lose money just because it's going down a couple percent or it's going up a couple percent. If you want to learn to be a savvy investor, then you have to really consider not selling. Think about it this way. Once you sell, you are out of the game. Once you sell at a lower price than what you initially bought it for, there's no way you can get that money back. Instead, if you hadn't have sold and you just give it time, you're just patient, you give it time to go back up in value, you'll make more than the money you had invested. You'll make more money than what you had initially started with. It would go up in value. Instead, don't just sell because it's lower than where you bought it at. Don't just sell because it's negative. Be a savvy investor. Be patient. One of the last mistakes I want you guys to consider is to avoid trying to get into the stock market in hopes for these big gains and this quick profit. It just seems as though everybody wants to start investing for these reasons, and it's very short-term like thinking. The profits you are looking for is in the long-term holdings and the continuation and consistency of investing into a company or into the stock market. Anything good in life comes with time, and so I highly suggest you guys just understand that long-term vision. Don't just sell a stock because it's not making the profits you wanted right away, and don't just buy into a stock assuming you're going to make these big profits or this quick bucks. That's exactly how you lose money, and that's a very fast way to lose a bunch of money. But that's all I have to talk to you guys about today, and so thank you very much for sticking around and watching this whole video. If you have any questions, please leave down a comment, like the video if you enjoyed it, and subscribe if you want to see more. Thank you guys very much. Have an awesome day.